Hey guys, welcome back to another week of let's figure out what in the world's going to go on. So if you're one of my buddies, you always hear me say top of the morning to you. And I forgot to say top of the morning to you guys on Friday because I wasn't here. Guys, I have some eye issues and I'm getting this eye checked for swollen retina and I have to have surgery. So if I ever miss a day or here or there, please just say a quick prayer for me that everything's going good with my eyeballs, and I'll hopefully be back the next day. So we're going to talk about today is what in the world the markets are expecting for this week from the Fed, because basically everything revolves around the Fed right now, doesn't it? You see the banking collapse. Why? The Fed raised things too much. Interest rates are skyrocketing. Why? To curtail inflation. Why? There was too much printing of money, and the government sent out too much money to everybody, and thus caused an inflation tidal wave to come through. So now we're picking up all the pieces to this stuff. So my job is to make it make sense to you guys in common terms. So over the weekend, we saw some things, and I'm going to show you guys what my analysis looks like for this week. And I always pride myself on the whys. So if you guys are confused with a lot of these things and you don't understand the whys behind it, let me know down below and I'll post some videos to explain any answers that you guys need, the answers to the questions that you have. So let's get on to today's events, and we're going to look at is the markets right now. The markets are going to basically be on pause. The reason being is it's Fed week. So what's happening today and tomorrow with the Federal Reserve's meeting, and they have, well, I won't say it's yesterday and today. They've been meeting for the last 2 weeks to try to put an end to this banking turmoil. But this week, what they're going to do is they're going to meet, and you see the FOMC meetings, that's the Federal Reserve meeting. They're going to meet today and tomorrow and figure out what in the world they're going to do in regards to interest rates and the why behind it. Again, why they're raising interest rates is basically, cut off inflation. Let inflation stop where it is and start to deplete from here. And we need it because prices of everything are going up way too much, and especially on the housing front with things as well. So here's what you're looking at the screen. This is the screen that I look at on a daily basis. If you're a mortgage advisor and you like this and you really want this in-depth research, you can subscribe down to MBS Live down below. If you want a newsletter from me that I don't sell and I don't really even reach out to you guys with, it's just to keep you guys acclimated on what's going on with the market, you can subscribe to my newsletter down there as well. So let's get on to today's events. Here's what you're seeing in the bond markets. Look at the screen right here. All of them are down. Well, the MBS, or the 10-year Treasury right here, what it has in focus, and if you could see up at my shoulder right through here, it's hard. This is hard to do on a reverse screen. So if you're looking at the 10-year Treasury, it's represented in the yield that you see the number of. And then if you move over to the side right through here and over through here, this is giving us the price. It's confusing. So just look at it. If you have 3.4, that's not a price. If you have 100 and plus, it's a price. So what's going on here that all you have to really focus in on are rates are going up a little bit. How do we know that? Because the bond prices are down. So basically, bond rates and bond market works like this. If the price of a bond goes down, there's an inverse. Basically, think of it as flip-flop. If the price goes down, rates go up. If the price goes up, rates go down. So we love when the prices are way up because it drives down prices. What's happened over that time frame when the Federal Reserve was artificially lowering rates, they were buying bonds especially mortgage bonds, in the tune of $40 billion a month. $40 billion. So now they're not buying any, and now we're having some liquidity issues in that, and as well as in corporate bonds. But if that's over your head, guys, don't worry. Let's put all this thing in the common sense language for you. First thing I want to do is go over to Yahoo Finance. I'm basically boycotting CNBC right now because their views in a lot of cases are really biased. So I'm trying to be your unbiased channel. I'm trying to think of a name because I don't care who's in politics right now. They're all in my view. Here's my view of politics. People get into politics, I still think, with the good in mind. Okay, they really want the good for the people. Then they get in there and they realize, I can't do anything. This is such a bureaucracy, and it's basically just a pay-to-play game that they either follow in suit with what their party wants to do, or they get booted out. So my goal here is to just give you guys the information I don't care who's in office. I just want the best for you guys to make sense of all this stuff. So what's going on in the markets right now, let's go to Yahoo Finance on the top of the page and let's see what the markets are doing. I don't know if theirs goes this way or not. Yep, there goes this way. Let's see. The S&P is up 19. The Dow Jones, I thought the Dow Jones would be completely flat today, but there's excitement right now because some of the bigger banks are stepping in to help out the banks that are kind of insolvent, and there's a lot more to that story we're going to uncover throughout the next weeks and maybe months. So you see the Dow Jones is taking off. It's up 300 points. NASDAQ is down just a little, and the S&P is up just a hair. But let's go down through just the highlights of all this stuff and see if there's anything here that we really need to discuss. Wilson sends bank stress signals bear market ahead. I'm reading this article, and I don't understand some of it, so I'll get back with you on that one. Banking turmoil. But you can see one consistent basis here. Bank stress, bank turmoil, state of the economy, anticipated, bank this. And then you get Bed Bath & Beyond and Foot Locker. I honestly, I didn't even really know. I knew they were both in business, but I didn't really know, if they have any stores left. Then you see Fed, bank bailouts. Everything is regarding the bank. So what we saw over the weekend is you'll hear Credit Suisse. They got a bailout by another big entity. Basically, a lot of these bigger banks are stepping into the smaller banks saying, you know what, we'll make you solvent. Another thing that's happening is the Federal Reserve is opening, they're saying they're going to open up their window to help these banks that are troubled with liquidity issues. So basically in a short term or in just to begin put it in layman's terms, they're saying, okay, guys, we know you loaded up on quality bonds. You bought treasuries and other corporate bonds that are really, really good. Okay, so the Treasury is coming out to these banks. Here's what happened part of the Dodd-Frank bill. Part of the Dodd-Frank bill made it that banks needed excess reserves, okay? Meaning they had to have excess reserves on their balance sheet. So a lot of them, what they used is they went out there and bought Treasuries and other corporate bonds that are usually really, really, really safe. So it's like putting it just in a CD. So they put it in these instruments, and then as the Federal Reserve kept raising rates, remember what we talked about earlier? If prices go up, rates come down. What did we see over the past year and a half? Prices went down, skyrocketing rates. So these banks are holding these investment vehicles, and the prices are plummeting, going down and down and down. That's what's causing rates to keep going up. So now on their balance sheet, they have all these bonds that they bought that are worth maybe half the value that they bought them for. So they have to hold it all the way to maturity. So the bond might have been a 2-year, a 10-year, a 30-year treasury. So they have to hold it to maturity. And they're like, well, we have a cash crunch now. So what can we do? So the Federal Reserve said, you know what? Bring your high quality stuff to us and we'll make you whole. So the banks, if I'm the bank, I'm doing the same thing. I'm like, here's my treasuries, take it, give me a short-term loan at really favorable interest rates that they're most likely going to get, and that's making everybody solvent. So it's not that easy, but there's a lot of that behind the scenes, and there's other banks stepping up to say, you know what, we'll take some of those assets, but we want a good price for those. So there's a ton of negotiations going on right now. So that's basically what's going on in the banking sector. So what we're having this week is now the Federal Reserve's meeting, and they're going to come out and tell us what they're going to do. So in today's video at 3 o'clock that we do live for Eastern time after the market closes, I'm going to go over with you guys to show you what the futures market on Wall. We look at the futures market in the Chicago Mercantile Exchange. The futures, it's an investment tool, and we're going to see what those are telling us that their predictions of what the Federal Reserve is going to do. I think they're going to either do a quarter point or do nothing. I would love if they do nothing, not because of this banking situation, is because let the dust settle, guys. Okay, so that's basically what you're seeing in the headlines right now. The next piece of this is let's go over to Market Watch. Is basically verbatim. That's that stuff. The Dow Jones is up 200 and some. The S&P is up and so forth. So I want to use both of these to show you guys basically what's in the news. End of everything bubble has finally hit the banking system. Credit Suisse and SVB might just be the first of many stocks, and then it's just basically the Federal Reserve, and banks. Okay, so let's get to the economic calendar for the week so I can explain to you guys based on the information that's coming in this week. Well, the Federal Reserve's probably already made up their mind what they're going to do. So we see on the screen right now is today is nothing. Monday is just a day. Tuesday, we have existing home sales. I'm really going to not look into that as much because the focus right now is banking and the Federal Reserve. So the last reading on existing home sales was there was 4 million units sold. The forecasts are expecting 4.17. Okay. It is what it is. This number is going to fluctuate high or lower over the next 6 to 12 months based on what Federal Reserve is going to do, obviously. Because if they do some things, make money cheaper, housing payments cheaper, people will jump back in the housing market. Trust me, there's a huge demand for it right now. If you don't believe me, watch my channels and watch all the data that you can find out on your own to look up this market. Wednesday is the day. Wednesday is basically the drum roll day that we're going to find out what the Federal Reserve's done. And I I really think the markets, well, I was surprised the market's up 300 points right now, but I thought the markets would be completely flat. The bond market, the stock market, everything. They're going to wait for tomorrow's news. So by the end of the day, when we report it at 4 o'clock Eastern, 3 Central today, I'll let you know what happened to the market. I would almost assure you that it's going to come back down in line to be basically flat at the close of today, but we'll find that out here in a minute. What I want you guys to educate, my goal on my side of the equation is to educate you guys on the financial markets and everything else. But a lot of people that we talk to on a daily basis, I'm a mortgage advisor. Okay, what I do on a daily basis is we talk to, on an average day, we have about 30 consultations. We talk to new home buyers. And one of the areas that people are completely confused about is their credit scores. You might think you know everything about those, but you might be greatly surprised at things you don't understand. So I actually created a website. Check it out. This isn't a pitch for that. Well, I guess it is a pitch for that because so many people just don't know the details when it comes down to credit scores. So go to creditscoresandmore.com, creditscoresandmore.com, and you're going to find this and a whole bunch of other things. The thing that we just added to it is Smart Credit. It's a system that I use. I was able to get an account with them for you guys to give you discounted rates. So here it is right here. Check that out, and you're going to find out more than you can possibly want to know in regards to credit. Okay, so based on the information that we have so far, and we don't really have that much because there's going to be silence on a lot of sectors right now, but what we know right now based on the information that's out today is the banking systems are in turmoil, but I think mainstream media and a lot of people are pumping this just for ratings and so forth because I don't think the banking system is as bad as everybody anticipates because they're still flushed with cash. Here's the one area that's concerning a lot of people, and I did a lot of research on this over the weekend, and there's been trillions of dollars pulled out of banks. Why? So here's what's happening that we're seeing. Is look at just Google what a CD rate is today. I need to move some of my mother's money over to something to get some interest because she's having some of her money in a savings account basically at 0.000008. Okay, but then I started looking at CDs at different places, and you can get a 1-year CD at like 4%. So a lot of people are doing just this. They're saying, okay, Mr. Banker, you're not giving anything basically for my savings accounts and my checking accounts. The money's just sitting there. I'm going to pull that money out and put it into some other vehicle, maybe treasuries. Treasuries on a 2-year treasury, you're yielding 4 now. So why would you not take your money out of that and put it into treasuries or CDs or something else? That's what's happening. So people are pulling their deposits out of the bank and putting them into other instruments. So the banks are losing a lot of money just because of that. And then when they start finding out, oh boy, I'm only insured to this amount. Are our books good? Are our investments good? Is everything else good? So now people have a double whammy to maybe think, is my bank really something I really need to use, or do I just need enough in my checking account to pay my bills? Another piece of this is a lot of the internet banking companies are offering much better yields than the bigger banks out there. So there's going to be a lot of people pulling their monies out of smaller banks, out of these other entities into the bigger banks, and that's what the whole point of a lot of the banking reform was to not happen. We don't want that. We don't want 3 big banks controlling the whole world at some point. We need a lot of checks and balances through the system. So that's talking about banking today. When we come back later today at 3 o'clock, I'm going to give you guys really what happened and some more insight into what's going on. But what you're seeing right now is the bond price for mortgages. So how do we determine what in the heck's going on with mortgage rates? Well, follow the mortgage bonds, and they're called MBSs, mortgage-backed securities. So what you're seeing on this is mortgage prices or bond prices are down 11. Again, what does that mean? Well, it means rates are going to tick up a little bit. Not much, because this is probably going to end the day maybe closer to 0. But a minus 11, well, basically a minus 5 is going to do nothing. A minus 11 might, increase rates 0.05 maybe, but I don't see anything really happening here because the Fed's meeting tomorrow. So where are mortgage rates? Well, this is where we closed on Friday. And it hasn't published yet, but this is rate sheets or the rates published by Mortgage News Daily on a daily basis. These are not my rates. These are not any individual bank's rates. These are the top 6 products people use when they're buying or refinancing a house. And this is a survey done by Mortgage News Daily. They survey lenders all over the country to figure out what's the average rate on a product. So the 30-year product, the average rate out there right now is 6.55. It's down 0.14. It's down about over an eighth in just a day. Basically, it's nuts right now, guys. So if you want to find out more what's going on in the economy, what's going on with the markets, what's going on with bonds, cryptocurrency, and real estate, check us out on a daily basis. If there's content you want me to cover that I'm not covering right now, please list it down below, and I'll try to incorporate that in my videos. But other than that, guys, I know it's a very, very generic video this morning because we really want to come back later this afternoon to figure out where the markets end and what news we got from today in regards to more banking news and the Federal Reserve, what the expectations are for them to do tomorrow. So join us today at 3 o'clock Central Time. I'll give you a little more insight into that and much, much more. Take care, guys. It'll be a live event that you can ask me any questions that you have. So tune in, join us back, and ask the questions that you have. Take care. See you then. Bye-bye.